Hi everybody, good morning. Welcome to this morning's K3 Hub CPD session. My name is Marie Wadeson and I'm a managing director here at K3 and I also lead the K3 Hub. K3 Hub is an integral part of the K3 advisory group. Our group is backed by Sun European Partners. We employ over 1,200 people who operate in 20 different brands across the group, which operate across business sales and deal advisory, wealth management, financial and restructuring advisory, technology advisory, and business services, which include specialist tax advisory services, financial due diligence and data advisory services, marketing and business development for professional services. Um, so a few pieces of housekeeping just before we get underway today. So as you'll have noticed when you joined the webinar, we are recording today's session. The webinar, along with all of our previous recordings, will be posted on the K3 Hub website, and that'll be done early next week. I just wanted to say a quick note on the use of AI note takers. So I know that many of you like to use them, and as an AI, but I guess my only precautionary note here is that we're aware that they can be imperfect and that the output may not always be a verbatim record of what was said. As I said, we are recording, and you can go back and look at that at any point in time for a recap. Q&A function is open. Please do feel free to ask questions as we go along. Our preference is that if you could use Q&A as opposed to the chat to ask your questions, our speaker knows at least where to look and has got everything in one place. We'll be posting a PDF of the slides into the chat shortly, and then we'll do that periodically throughout the session for anybody that arrives a little later. Right, so on to today's session. So we know it's quite a long session today, so we will be taking a couple of breaks and they'll be there or thereabouts on the hour. So on to our speaker in that case. So I'm really pleased to be able to welcome back Ros Martin. For those that have been with K3 Hub for a little while, I'm sure that you will know Ros already, but let me just take a moment to introduce her. So Ros is a consultant and a lecturer and covers all aspects of direct tax as well as stamp duty, land tax, and is a regular speaker at our webinars, as I've said. She also advises on a range of businesses. She advises a range of businesses and individuals on tax planning and dealing with full and aspect inquiry work. Today, Ros will be covering the different business structures, the cost of incorporation and how this can be done effectively, partnerships, IR35, associated companies, and potential CGT and IHT issues. Just before I hand you over to Ros, I just wanted to flag a couple of forthcoming CPD events to you that might be of interest. On the 17th of April, we've got a VAT update. 15th of May, we've got family tax planning and an IHT update. Ros, I think that's about it from me, so over to you.
Thank you very much, Marie, and welcome everybody, and hello to from me to you. Yeah, please do feel free to ask as many questions as you want to if you are watching this live. And again, please pop those into the Q&A box. It's easier. I will have the chat box open as well, but if you could put them into the Q&A box. We have had a couple of questions come in which have been forwarded to me, so I will pick those up as I go along. Okay, so business structures. I suppose it's one of those areas where we are going to cover a lot of individual bits and pieces, a lot of stuff which might, on the face of it, you might think, well, I know this, but the idea is to just kind of put it into context, wrap it all up together, join it together so that we can think about where we go. So if we start off with the basics of business structures, obviously there are going to be new businesses starting up who will be wanting to perhaps think about the type of business structure that they're going to use, and that may or may not be driven by tax, and we'll touch on the sort of the non-tax reasons as we go through this discussion. Many people will have different views on what they want to do, may depend on the sophistication of the taxpayer, and what their long-term aims are. Typically, you might be looking at a sole trade, a partnership, and that could include an LLP, or it could include a limited company. So those are kind of going to be what we focus on. And again, most people will be familiar with these structures, don't really need to be told about the tax treatment, but we'll just cover that off in a moment. There are then other ideas that people may come up with. So one area which I have had discussions with people about in the past are things like community interest companies. So this is a company which is a particular type of company. It's still subject to corporation tax. It still has various restrictions on it, but it is perhaps seen as being a good type of structure to use for particular businesses, particularly socially driven businesses. Often they are actually not going to fit the requirements of the person who is running the business because, for example, there is a limit on the amount of money you can take out and so on. But occasionally you will get people who come up with ideas of the way that they want to run a business. And obviously you have things like trusts running businesses, you have charities involved in trades and so on. All of those things are beyond the scope of this morning, but ultimately you might get somebody who is asking those questions about those types of structures, and you would simply have to go off and have a look and do some research as to whether that would be a good or a bad thing. If we're looking at the difference between different structures, and as I say, we all know this, but if you are a sole trade, you're taxed on all of your profits, even if you don't take it. But of course, they are easy to set up. You could get up tomorrow morning and think, actually, do you know what? I'm going to set up a sole trade. Yes, you then have to notify the revenue that you have started, but there is no paperwork needed. There is no additional work that needs to be done in terms of the structure. But of course, the downside is that there is no separation of business and owner, which means that if the business gets into difficulty, if it ends up owing money to people, then the business owner's own assets are going to be vulnerable. But plenty of people operate as a sole trade. I am still a sole trader even after all of these years, and many people express surprise that I have always been a sole trader. But we will explain as we go through why that is the case. Partnerships are the same as sole traders to the extent that the partnership as a whole, the individual partners combined, will be taxed on all of the profits that arise, allocated between the partners on whatever the terms are agreed. The liability in relation to the partnership can be limited by using a limited liability partnership. So that question of there being no separation between the business and the owner can be managed if you have an LLP, although of course the question of limited liability for both an LLP and a limited company may well be watered down in certain situations, because if you, for example, get finance from a bank, they may well insist on personal guarantees, and there may well be debts where you have a personal guarantee. Limited company, the sort of general provision is that you have a double layer of taxation, in that you have the company is going to be taxed on its profit under corporation tax, and indeed then you pay to extract money from the company. But we'll talk about that in a moment, the most tax effective way to get money out of a company. Obviously, for both an LLP and indeed a company, there are more legal requirements. You have got to register it. You have got to have a framework. Limited companies, you do effectively get, there are more stringent requirements. Somebody has made the comment that sole traders are not taxed on all of their profits because they can be treated as a cash basis. And from April 24, cash basis is the default. Yes, you're absolutely right. You pay income tax on money actually received rather than that which is invoiced. But obviously, over the lifetime of the business, you will be taxed on everything. But the point that we are making is that it's not like a company that is, you can mitigate your immediate tax liability by retaining profits. If you have cash basis, yes, you're absolutely right. You are only taxed when you receive it, but you are going to be taxed on all of the money that you receive. So whilst you are correct, that I can't disagree with what you are saying, and thank you for putting that comment into the Q&A. So what you can do is, of course, calculate the tax burden in different structures. And what we can do is start off by looking at the tax difference between a sole trader and a company that has a sole director or a shareholder. And obviously from the perspective of the sole trader, we are also going to be including the Class 4 national insurance contributions, and we are using the current rates and rate bands and so on. Now, this is a very artificial calculation, and for this reason, and that is we are making the assumption that actually all of the money is distributed from the company. And what we do is we give a salary initially at the secondary NI threshold, and what we don't take account of is the differential cost of operating through a company, and therefore that may well be higher in some circumstances. Actually, what this slide does is it looks at the net take home over a range of profits in various different situations. If you are a sole trader, if you pay a salary at the personal allowance without the ability to claim employment allowance, where you have a salary at the personal allowance, but you do have employment allowance, or where you pay a salary at the lower earnings limit. So the difference between, and as I say, you are paying a salary, but then you are taking all of the profits out as dividends. And I know that it is very easy to make the comment, well, in practice, that doesn't ever happen because effectively you retain profit within the company in order to mitigate your tax liability. But certainly at lower rates of profitability, not taking all of the money out of the company may well be illusory. And even at higher earnings limits, people do have a tendency to want to spend the money that they are earning. So, you know, whilst very well-off companies that are making significant profits, there may well be significant retention within the company. But at lower levels, I'm not sure that that really happens. So what is the employment allowance point? Well, if you are paying above the lower earnings limit as a salary, the company is going to get charged Class 1 national insurance contributions. And they get employment allowance, but there is an anti-avoidance provision which says that if you have only one effective person for whom the company is a secondary contributor, then you don't get the employment allowance. So a one-man band where you only have one director shareholder would not necessarily get the employment allowance. And that in itself is quite a nuanced point, and we will come on to that in a minute. These are just figures, but what we can see from these figures is effectively the take-home pay or the take-home amount at all profit levels is higher as a sole trader than it is if you are a limited company, regardless of the circumstances. And that is mainly to do with the increase in rates of corporation tax. And we did have a question as to what this comparison was, although they were talking about the comparison between a partnership and a limited company, which we'll come on to at a sort of a 350,000 profit figure. And yes, if we're making a direct comparison between a sole trader and a one-man band company, then again, that differential does continue. You are going to be better off as a sole trader. But as I've said already, this is as artificial if it assumes that all cash is withdrawn in smaller businesses. That may not be a reality. Now, one of the other options that you've got is, of course, to have more than one shareholders, so not to have a sole shareholder, particularly if you have got a spouse or civil partner who has got available basic rate band or available personal allowance. I mean, I'm not sure how many households these days have a situation where you have perhaps got a stay-at-home spouse or civil partner, but it does exist. Now, typically, when we are talking about giving shares to other parties, then we are perhaps worrying about thinking about the settlements legislation. And this is because there is an anti-avoidance provision, which means that if you transfer income to other to a person where you retain an interest in that income, then it remains taxable on you. And it's actually if either you or your spouse retains an interest in income that you have an issue as well. And so there is this idea that it is difficult to transfer shares to particularly your spouse without there being a problem with the settlements legislation. And for those of us who are old enough, you will remember the Optic Systems case in 2005, where HMRC tried to make this argument in relation to a husband and wife company. They lost that case in the end, but and then said that they were going to change the legislation, which is something that they never did. And actually, post Optic Systems, there is not a huge amount of evidence that the Revenue do make arguments about the settlements legislation with husband and wife type companies. There are still some things that you've got to be careful about. So, for example, if you are paying dividends to another family member, the spouse or the civil partner, you would probably not want those dividends to be paid into a joint bank account. And the other bit of the settlements legislation you have to be careful about is if you transfer shares to minor children, so children under the age of 18, then you are automatically caught by the settlements legislation. But there would be no reason why you couldn't give shares to a child or a young adult who is over the age of 18 if you are paying, for example, for a child, you're funding a university education, then you are going to, you could give them some shares in a company, different class of shares, enabling you to vote dividends, particularly if they had no other income streams. So there are some situations where giving shares to other family members might be worthwhile, and that would obviously, alter the overall burden. And of course, if you're talking about a sole trade, then getting involved in a partnership might well be another option. And I'll come back to the last point on this slide, but if you had a comparison between a two-partner partnership and personal allowance with no employment income, salary, no employment allowance, or a lower earnings limit salary. Sorry, that should say salary, but with the employment allowance, because with two shareholders, you would assume they're both getting a salary, and therefore the employment allowance would be available. And again, you can see it becomes much more marginal. It is still slightly better with a partnership. And again, the question that I was asked about much higher levels of income, it's pretty much the same. You are still going to get a bit of an advantage with a partnership. What about specific reasons for a structure to be put in place? And I think that this is just in some ways quite a good point in time to be discussing this, because of the looming Making Tax Digital giant that is coming upon us from the 6th of April. I am very well aware that a lot of people who have previously operated as sole traders have considered whether or not to incorporate into a limited company or indeed to form a partnership, simply because then that means that they will not be within Making Tax Digital. And I certainly know that there are accountants who have pushed their clients into that particular scenario, in order to avoid them having to comply with Making Tax Digital. Going into a partnership is going to be delaying the point at which MTD is applicable. It is going to come in for partnerships at some point. The timing of that is very much, I think, going to depend on how it goes for sole traders and property owners. Companies are never going to have to comply with Making Tax Digital. But again, you need to be careful because HMRC have published a consultation document in the last couple of weeks, where they are going to start insisting, or they are suggesting, that they want to increase the reporting requirements for close companies, so for small companies, particularly in relation to things like directors' loan accounts. So it looks like we are getting to a point where you are going to have a reporting requirement in relation to dividends and also in relation to transactions with on directors' loan accounts. So going into a limited company is not necessarily going to be something which is going to materially reduce the compliance costs. But, you know, again, that is something that we need to think about. Okay, a few questions have come in. Sole traders are massively exposed to personal liabilities, and including bankruptcy for providing, for example, incorrect advice. Limited company directors have limited liability protection, which often far outweighs the tax benefit of sole traders. I think I had already made that comment at the beginning, but thank you for making that observation. I mean, again, as I say, it does depend on your circumstances. It could be argued that I am exposed to significant personal liability because of the job that I do, but I have still felt that again, it's never, and the reason I have to say that I've never felt it worthwhile incorporating is because up until relatively recently, I have always spent all of my income, and that is because of various reasons which I don't necessarily need to go into here. But, you know, again, that's why it has never been particularly cost effective for me to operate through a company. Anyway, that is, again, very much a personal choice and clearly a decision that I have made myself. What about the level of dividends? Does that have to be pro rata if you have different classes of shares and you have got effectively again, is it still another question, is it still acceptable to issue alphabet shares to a spouse to vary dividend payments, and should the rights attached to the shares be the same for each class of shares? Yes, you can very definitely issue alphabet shares. Now, obviously, you need to make sure that the articles of association allow you to pay different classes, pay different dividends on different classes of shares. Some older articles of association need to be amended to allow you to do that. I would always recommend that the rights attached to the shares should be the same for each class. So I always like to see situations where you have got voting rights, you have got capital rights, as well as having income rights. In relation to spousal shares or shares being issued to the spouse or the civil partner, that is actually much more important because the settlements legislation would not apply if you were to issue shares to a spouse or civil partner that only had income rights. So at the very least, if you are giving shares to a spouse, they would need to have the full plethora of rights. Someone's saying, are you saying it's not worth splitting shares between the husband and wife because the husband would still have an interest in the dividend payments, so you would be taxed on them regardless? Not sure if I misunderstood what you were saying. I did rush through that point a little bit, so I do apologise if there was a misunderstanding. In basic terms, the legislation does say that the spouse still has an interest in the dividend payments, but then there is a get out of jail free card which says that as long, and this is where the point about the having the shares having capital and voting rights, as long as the shares are not wholly a right to income, which they would be if you just had income rights, it can apply. So yes, you are fine as long as those shares have full rights. As the dividend route leads to lower taxable income, the potential loss of child benefit might be an issue, as is the 100,000 limit in comparing the two structures. Yes, obviously, if you have got a higher earner who is, losing their personal allowance, losing their child benefit, then again, it's always going to be useful to think about mitigating tax liability. If the shares have the same rights but are called A and B shares, could HMRC argue that they are effectively the same class, only differentiated by the A and B? If you have got articles which clearly specify that there are different classes of shares and those different classes of shares are properly articulated, it is my understanding, and I'm not a corporate lawyer, but it is my understanding that HMRC are not able to make that argument because in corporate law, they are different classes of shares. Now, what I would say is that I have seen situations in the past where people have tried to do this kind of thing on the cheap, have not wanted to pay to have somebody who knows what they're talking about doing the paperwork. And I'm not saying that everybody who does this doesn't know what they're talking about, because that's clearly not right. There are plenty of people, and I'm sure everybody on this call would fall into that definition, who is entirely competent to do these kind of things. But I have definitely seen circumstances in the past where the methodology in which this has been enacted, issuing of the shares, doing the paperwork, and so on, has left people vulnerable to that kind of argument because actually legally they've not done it properly. So I think that I'm not saying that these are not without risks, but if you do it properly, I think the cases where I have probably seen most difficulty is where you have got someone who is different, where they've had shares issued as normal shares, and then they try and recategorize them into A and B shares. But you can do it. And someone saying just calling them different names wouldn't differentiate the shares for the purposes of tax. I think it is possible to do that, but maybe we agree to disagree on that point, because, as I say, I'm not a corporate lawyer, but I have certainly had plenty of cases in the past where the revenue have accepted that they are different for tax purposes if they have had similar rights. But if you feel that that is important, then I think the thing that is important, if you particularly have got husband and wife shares, is they've got income and capital rights. If you wanted to not have voting rights on one of the shares, I would be fairly relaxed about that. But certainly with husband and wife shares, they have got to be more than just income. Somebody has said, how important is it to pay dividends into separate rather than joint bank accounts? I personally believe that it is quite important. But I would also acknowledge that it is a viewpoint that not everybody agrees with. And I was talking about this particular point on a webinar that I gave relatively recently. I can't remember exactly when it was. And I had somebody who was absolutely adamant that I was wrong about that. And I think my reason for doing that, for feeling that it is important, is that many, many years ago, I did have, it was sort of around the Arctic Systems case. I think it was after Arctic Systems, but before the revenue had kind of completely backed down on the settlements legislation. I did have an inquiry with the revenue where the officer who was undertaking the inquiry basically was certain in their technical analysis that they were that you had to have separate bank accounts. So I have always felt that if it was at all possible, that it would definitely be safer. It would remove that risk. But as I say, I am also fully aware of the fact that it is not something that everybody agrees with me about. And indeed, not everybody agrees with me about the risks involved in having shares to family members in the first place. And so, again, I do think that it is a point where there is still some debate between different people, and I'm quite happy to acknowledge that. Okay, so let's move on now. And we've already talked about partnerships versus limited companies. And of course, the next thing, we have to think about is that with companies, part of the advantage, the tax advantage you get is the ability to delay tax until money is withdrawn. But of course, the other question that always gets asked at this point is what is the best way to withdraw money? Now, in the first instance, we are talking about dividends versus salary. I will pick up in a minute other ways of getting money out of companies. Obviously, the actual position has been influenced first by the change in the corporate tax rates, but also going forward, the announcement that we've had about dividend tax rates. Now, the way I do these calculations, and I just like to explain it, is I take a notional £100 that a company wants to distribute. If you're going to pay that as a bonus, and assuming that you are above the lower earnings limit, the company would have to pay Class 1 national insurance contributions. You have the net salary being paid out, and then assuming that we have someone who is a basic rate taxpayer and paying the main rate of national insurance, they have their tax to pay. And so the amount out of that starting £100 is retained is £62.62. So we have a marginal rate of tax of 37.38%. With dividends, you have to knock off the corporation tax first. You get an amount, because dividends are not tax deductible. We get a net distributable reserve. Income tax is payable on that. And so we get to the marginal rate of tax being 26.09%. Now, obviously, from the 6th of April 2027, the marginal rate of tax is going to go up because the dividend rate of tax is going to go up to 10.75%. In fact, it is going to go up across the board. So we can see that because there is corporation tax involved in this calculation, actually, when we look at the comparison between salaries and dividends, we actually have to do the calculation for the three rates of corporation tax: 19% tax, 25% tax, and then 26.5% tax. So companies typically pay 19% up to 50,000, 25% over 250,000, and 26.5% between 50,000 and 250,000. Before somebody picks me up on this, it's not always 26.5% because it depends if there's any dividends received from subsidiaries. It can be higher than that, but the standard is 26.5%. And the point at which you start to pay higher rates of corporation tax will depend on whether you have any associated companies or whether your accounting period is less than 12 months. I'm going to talk about associated companies and the complications there going forward in a moment, or probably actually later on this morning. So I'm going to cover those points off. And we can see, I thought the dividend tax rate increased on the 6th of the 4th, 26. That's an interesting point, actually. I will just check that. I thought it went up from the, oh, you're right, it is 26. It's the property rate that's going up from 27, isn't it? I do apologise. Yes, that slide is wrong. It is 26 rather than 27. Apologies for that. But the calculations will be the same. So we can see from this that it is effectively when you get to sort of higher rates of corporation tax, where you are a higher rate taxpayer or an additional rate taxpayer, actually it can be cheaper to pay salary rather than dividend. And again, that is going to be compounded from 26 rather than 27. That is going to be the point. Somebody said, do the salary calculations here assume no employment allowance is calculable? To be honest with you, when I'm doing these calculations, I don't look at the employment allowance and I don't look at things like the dividend allowance because I'm kind of thinking about a comparison between bonus versus salary dividends. So I'm kind of talking about top-ups really. But you're absolutely right. The salary calculation would assume that the employment allowance has already been used, or indeed is not claimable. And again, we can do the same calculation, and it should be from 26 rather than 27. I will update the slides and send those over to Helen at K3 for when they are uploaded onto the system, and we will look at that. So, again, it's complicated. It's quite marginal when we get to higher rates. And that's really because, and the reason that, if you want to look at this logically, it's because as you are paying higher rates of corporation tax, obviously you get the benefit of the corporation tax deduction. And with dividend tax rates going up, it's that. But from an individual perspective, if you were looking at this on a company by company basis, it's very difficult to make assumptions, and really all you can do is detailed modelling, because you might think, okay, we'll pay salary to get the corporation tax, the company profit down to where we're paying 19%, and then we'll pay dividends. But of course, that ignores the fact that when you're working out the personal tax, you actually get the salary is the first chunk of the tax, and then it's the dividends on top of that. So it works the wrong way round. So it is quite difficult to make assumptions. Now, another question that's been asked is that if the share structure is complex, is it worth getting HMRC clearance with the structure before issuing the shares? I don't think, in all honesty, that you would be able to get revenue clearance on this point, because I think that the revenue would argue that that was clearance, the purpose, that would be for the purpose of tax planning. And again, that is just, I don't think you would be able to get clearance. So yeah, it would be a nice idea if you could, but I suspect that you wouldn't be able to get clearance for that. Okay, what about other ways of extracting value? One of the things that people will often think about is accumulating the money in the company and then winding up and getting the money out as capital. Now, obviously, the increase in BADR, when I say reduction, I mean the reduction in the value of BADR, has reduced the benefit of doing that, in that now from the 6th of April this year, we are going to be talking about a BADR rate of 18% on a maximum of £1 million. And alternatively, it is, going to be something which you would have to do the modelling. I mean, if you don't need the money, accumulating cash in a company is, something that is worthwhile. Obviously, there is a bit of a chicken and egg situation with accumulated cash, because there is the possibility that if you have got a lot of cash in a company, particularly if you are investing it in any way to increase the return, then you might get to the stage where it is no longer a trading company and you wouldn't get the BADR in the first place, although we are seeing very, very few challenges from the revenue on that particular point. So I'm not sure how much of a risk that is. I think the revenue have taken the view that they're going to tighten up the BADR rules rather than perhaps challenge quite as much. Although, as we will see at the end, we are going to talk about BADR in a bit more detail, so I'll perhaps come back to that point. Pension contributions were always seen as quite a neat way of getting money out of a company, because you get the tax deduction on the assumption it is wholly and exclusively for the purposes of the business. And again, even though there has always been a perception within the profession that pension contributions are vulnerable if they are high to being challenged under the wholly and exclusively rules. Again, it's not an area where we really see a great deal of challenge from the revenue. But of course, the big issue that we have, and this is something that I definitely know is coming in from 2027, is that from the 6th of April 2027, pension funds or residual amounts in pension funds are going to become subject to IHT. And I think that that has sort of mitigated, I think, the benefit that people have seen of shoveling huge amounts of money into their pension. I mean, there is the alternative, which is what I am now intending to do, and that is to just spend the money in my pension, although there are clearly tax implications of getting it out. And indeed, the great orange one across the ocean is doing his best to reduce the value of my pension and then doing a very good job of that. So it may well be that I'm not actually going to have a problem for very much longer. But generally, I think that people's attitudes towards pensions has perhaps changed a little bit. But certainly, and obviously, extracting value from your company as a pension contribution does have the disadvantage that you can't get your hands on the money until the point at which you retire. But it is something that perhaps clients will think of doing. Paying wages to the family if you can convince your kids to come and work for you. Owning the business premises and renting it out, although again that is going to have direct tax implications. It is possible that you can pay loan interest if anyone has got the personal savings allowance available, or indeed the savings band available, because they are paying themselves in dividends and only have their salary within the personal allowance. Then it may be beneficial to pay loan interest, but in reality, it is often quite difficult to achieve significant tax savings. And going back to the point of the question that was asked about tax clearance, we have had a comment to say, yes, tax clearance for anything these days is becoming more and more difficult. And I think I would agree with that. I've had a couple of non-statutory clearance applications pushed back in the last year, where the revenue just said, we don't see that there is any uncertainty about the way that the legislation operates. So in one of them, they did kind of give me informal agreement to what I'd said, but the other one, they simply refused to comment. So partnerships, we've already talked about as being a potential way of mitigating tax liabilities. I suppose it is just worth thinking about issues that we might have with partnerships. So there are restrictions on partnerships. And indeed, that can mean that in certain situations, there can be problems. And indeed, we have had a lot of use of partnerships in tax avoidance schemes. We now have specific legislation in relation to things like mixed partnerships, where you have a corporate partner. We have the salaried partnership provisions, where you have people who are members of LLPs, but not really taking on any risks or responsibilities in terms of running of that partnership, where their income can be taxed as salary rather than dividends, rather than as self-employed income. There can be complications with bringing people in as partners from a CGT perspective, particularly where there are connected parties. Normally you're okay if it's a trading partnership, and again, that's because you can claim holdover relief in relation to any CGT liabilities arise. But I do see problems with things like property investment partnerships, where you bring in partners, so it can be difficult. And as we've already pointed out, if you want to limit your liability, there is no reason why you can't use an LLP. Going back to the point about pensions, somebody has raised the issue that there are double tax treaties which would allow you to extract money from pensions at zero tax rate whilst not resident in the UK, and then later to return to the UK, thus avoiding the tax on extraction from pension funds. That is true. And there are actually even some double tax treaties, Portugal, Israel, where you don't have to pay tax in the country of residence as well. I mean, obviously, you would have to check the tax position, and you would have to remain outside the UK and non-resident for at least 5 years so that you weren't caught with the temporary non-resident rules. And yeah, there are always planning options in terms of going overseas, but you have to be prepared to leave the UK for a considerable period of time. And, you know, for example, I currently have a couple of clients who went to Dubai and took all the money out of their pensions at a zero tax rate, and would now love to come back to the UK. So it is not necessarily straightforward tax planning, but, you know, as with all of the things we discussed there are sometimes options which may be available. It will obviously depend on where you go, what the double tax treaty says, and what the tax position is in the place that you are going, and the fact that you are willing and able to stay out of the UK for 5 years. And finally, in this section, obviously, there may well be particular reasons for using a particular structure. Risk, wanting to limit liability, as we've already said, that can be done by both using a limited company and also a limited liability partnership. Wanting to avoid MTD, again, we've already touched on that, very key at the moment. One thing to just mention, and you have probably had sessions on MTD before, but if you have a client who has formed a partnership or formed a limited company in the current tax year, but would have had income over the mandation threshold in 24-25, you will need to ring up the revenue agent helpline, ask to speak to the MTD team, and notify them that they will not be registering for MTD because they no longer have any sources of income that need to be mandated. Now, what they will do if you don't do that and you don't register, I don't know. I have got a couple of clients who are in that situation, and for the purposes of being able to talk about it on my lectures, I had wondered whether I wouldn't phone the revenue and tell them. But because actually you are only going to be liable for penalties for failure to submit quarterly returns, and the revenue have indicated they are going to have a soft approach to penalties in the first year. So I might not tell the revenue and see if we get any correspondence, and if we don't, perhaps notify them before the first quarterly return is due. Sometimes people might want to look at having something like a limited company because of reliefs which are only available in one structure, and the obvious one to think about is R&D. But again, that, you know, the sort of the difficulty in getting R&D reliefs may well mean that actually it is not quite as easy or not quite as beneficial as it might have been in the past. So again, it is not necessarily going to be as straightforward as it might have been in the past. So, you know, again, you'd have to look at that on a case-by-case basis. Sometimes businesses choose partnerships because they want to avoid benefit in kind issues. It was something that was looked at in relation to things like company cars, and perhaps having a service company and a partnership running in parallel with that. But again, HMRC have done a bit of compliance work on that, so it may not be that straightforward. And you know, that would be why. And as I said at the beginning, there are always going to be situations where we have got, oh gosh, it's kicked me out of screen sharing. Let me just get my slides back on. I don't know why it's done that. Right, okay, let me just share my screen again. I do apologise that sometimes with these online courses we do get technological problems. Okay, let me just put that back into screen mode, and I will. How actually is it now sharing my whole? Okay, why is it not? Where is it? Where is that screen gone? Okay, just share that. And then start that and see whether it shows me what I'm sharing. Okay, I don't know why it's come up. Let me just stop the share again. I do apologise. Why is that coming up? That is coming up as a slideshow. It's always so difficult when these things happen mid-event. Share. There we go. That's what I want to do. Perfect. Hopefully that's come back again. Okay. Somebody said, MTD, a client with more than £50,000 of self-employed income in 24-25 is incorporated in 25-26, so no longer self-employed, but has a possible contract in the future that cannot be done through the company. Do you know how this will affect MTD mandating? If their original business has ceased, then you do not have to mandate into MTD for 25-26, as I understand it. So you could contact the revenue, say that they will not have any income that needs to go through MTD from the 6th of April 26. When they then get that future contract, they would recommence as a sole trader, and then the point at which they would need to mandate through MTD would be determined by that. That's my understanding of how that would work. I think that assuming that they have definitely ceased at this point in time, which from what you're saying does seem to be the case, then they will be okay. You don't have to mandate. You might want to mention it if you do phone up the MTD helpline, that they may be recommencing in the future, and see if they say anything different. Although I would have to say that I have had some very curious advice from the MTD helpline in the past. So, okay, rather than calling the MTD team, HMRC have advised us to register and then immediately deregister. Is this much quicker? Oh, that's interesting. Thank you for that. I've not heard that. And so that's a useful point to make. So thank you for sharing that, and that may well be quicker. Yeah, thank you for that. Okay, we have got a few minutes before we have the first break, but let's just talk about the cost of incorporation. We'll assume that you're wanting to move from a sole trade to a corporate structure. Would be the same if you were moving from a partnership to a corporate structure as well. So I've just put sole trade because it's really unincorporated to incorporated. It's going to be a cessation of the unincorporated business. That the timing of that used to be quite critical, but now, of course, basis periods are aligned with the tax year, and so it's not, the timing of cessation is not quite as critical. Obviously, you have got things like what is going to happen to the stock, what is going to happen to the capital allowances pool, and then we need to think about whether there are any capital assets, the most common ones being business premises or goodwill and other intellectual property. Very occasionally we will get patents, which would obviously fall within the IP heading. We don't typically get anything else. Things like cash, bank account balances, debtors, and so on can go across without there being any tax implications. Before we talk about capital gains, probably the one we need to think about is capital allowances. That will be a disposal on cessation from the pool. The default position is that it will normally go across at market value, but we'll come into that in a minute. And you will have either a balancing charge or a balancing allowance. depending on what the tax written down value is. Now, often you will have 0 in the pool because AIA will have been fully available. Obviously, the exception will be if you have cars, because obviously AIA is not available on cars. But even if you have a nil balance on your pool, you still have to consider these implications. If it is a connected party transaction, so if you are transferring into a company with which you are connected, it would go across at market value, but you can elect for it to go across at tax written down value if you wish to do so. If it's being gifted across, even if it's not a connected party, it is treated as if it is going across at market value. So normally you would put at least £1 on the transfer. But again, you can elect if it's the new company is succeeding, and most people will elect for the assets effectively to go across at tax written down value. There is no advantage particularly to putting a value on them because the company would not get annual investment allowance if it is a connected party transaction. So, typically it is not going to be, most people, and as I say, most people, most smaller businesses are going to not have an issue with that. Very occasionally you will get businesses that have got very little value in the capital allowances pool is 0, but they still have assets that are of particularly high value, and so it's obviously going to be very important to make sure that that election is put in place, so that it does go across at the tax written down value, rather than anything else. Company also wouldn't be able to claim any of the first year allowances that are available in that situation. So any capital assets that you've got, it is going to be a connected party transaction. So it will be treated at market value. If the market value is more than is paid, then again will crystallise. Option 1 you have is to allow the gain to crystallise, pay tax, get the value of the asset in your loan account, and then be able to withdraw that without paying any additional tax, but remembering that you do not get any BADR on transfer of goodwill or customer related intangible fixed assets. So that would include things like client lists. Transfer in exchange for shares and claim incorporation relief with a limited ability to create a loan account and having to transfer all of the assets, or you could gift the assets on a case-by-case basis to claim holdover relief and the possibility of creating a loan account up to the base cost. And we are going to look at incorporation relief and holdover relief after the coffee break, because it is now 10 o'clock. What I normally do is split a 15-minute coffee break across. So we'll have 7 minutes now. So I'll be back online around 7 minutes past 10. And if you have any questions while you are making your coffee, please feel free to pop them into the chat box. Started again. Going back to MTD, we've had a question come in. Going back to MTD before I go back to incorporation. I have a client who had more than 50,000 turnover in 24-25, but will have in 25-26, but is starting as a partnership in 26-27. Will he have to comply with MTD? Yes, if he's still going to have that level of turnover in even for part of 26-27, he will, but then deregister if he's got no further income after he has transferred into a partnership. Okay, so we're talking about capital gains tax on incorporation and on the fact that you can sell your assets, or you can look at incorporation relief, or indeed holdover relief. So incorporation relief, basically all of the assets are transferred into the company other than the cash. You don't have to transfer the cash, but everything else has to go in. It has to be transferred as a going concern, although again, that is not typically a problem. And it has to be transferred wholly or partly in exchange for shares. And then what you do is that the acquisition cost or the value of the shares issued is the underlying assets being transferred. and the gain is rolled over into the value of the shares. And so if you then sell the shares in the future, you are going to have a reduced base cost, and that therefore your capital gains tax liability will crystallise at that point. It is very difficult if you are claiming incorporation relief to put any credit into the loan account, because that brings part of the gain into play. And it used to be you could just do a bit of an exercise to sort of put a little bit into the loan account to give you a gain equal to the annual exemption. But given that that is now only at a level of £3,000, it's not going to be a huge amount. A company acquires the assets at market value, which means that if they then sell them in the future, they are potentially going to have a reduced capital gains tax liability. There are changes to incorporation relief with effect from April 2026, so from the 6th of April 2026. Up until that point, incorporation relief is automatic. You don't have to claim it, but you can claim to disapply it if you want to, although I would very rarely think that that would be something that you would consider. But for transactions on or after the 6th of April 2026, you will have to claim the relief. And you will also have to provide HMRC with more details about the transaction. And I think that that is because, my guess anyway, would be that the revenue are starting to ramp up thoughts of inquiring into incorporation of property businesses. I think that there may well be something behind that. So the reason it is difficult to credit your loan account is basically the relief is calculated as the value of the shares received divided by the total consideration. So if you get a big lump of value into your loan account, that means that the value of your shares is reduced in comparison to the total consideration. So you get gain coming into charge. Acquisition cost, a couple of other issues. The acquisition cost of the shares is the cost, is the assets less the liabilities. And so you could have a situation, and again, I had one recently, where the properties concerned were highly geared because they'd been remortgaged. So there was actually not a lot of equity in the business, but the properties had been held for a long time, and therefore the gains in the properties were high. And what that meant is that actually claiming incorporation relief was, you couldn't cover all of the gain with incorporation relief because you didn't have enough headroom in the value of the shares. It is not anything I have ever come across with in relation to a trading business, but it is typically something that you might come across in relation to property businesses. If it is a partnership, again, you need to have a look at the partnership assets. If all of the assets are held by one partner, and I was talking earlier on about one of the issues that we have with partnerships is the fact that if you bring somebody into a partnership, there is a capital gains tax liability. And if you can't claim holdover relief, that might cause problems. And again, this is an issue that we sometimes have with property partnerships. But if you remove the liability to capital gains tax when the partnership is formed, you will then end up with a partnership where one partner doesn't actually have any capital assets, and therefore they don't have anything to transfer into the company in exchange for shares. So that may well cause some issues with the structuring of a company. And again, I had a case last year where the mother had 100% capital share in properties. She brought her son into partnership with her as a way of mitigating some of her income tax. So he got allocated an income tax, a profit share. But they didn't want him to have a capital share because it would trigger a capital gains tax liability. They then decided that they wanted to roll that into a company. but he had no capital asset to transfer into the company in exchange for shares. So the only way that it could be done would be if she was issued 100% of the shares. Now, there might have been ways of getting around them, but they were problematic. As you know, again, you've got to consider all of these points. Holdover relief operates on a much more straightforward basis, because you look at it on an asset by asset basis. You can transfer assets into a company either as a gift or return to value. There is no requirement to transfer any other assets, and the gain is rolled over into the value of the asset. But the company then has a reduced base cost for tax purposes if it's ever sold. I mean, typically, it is not going to be something that will be an issue unless the company is thinking that they will sell the shares. And obviously, you can only claim holdover relief if it is meets the conditions, and broadly that means it has to be a trading business. So I've already mentioned incorporation of property businesses, and they do cause particular problems. A property business can claim incorporation relief because incorporation relief covers businesses, not trades. Holdover relief covers only trades, and therefore it is only available to trading businesses. But to be a business, you have got to have an activity that is beyond just investment, and therefore it is going to be not available to everybody, particularly if you do not have very many properties at all. So, it is something, trading businesses, it is fairly straightforward. And somebody has made the observation, obviously, all of the tax implications have to be considered in light of broader legal implications. What is going to happen on death, divorce, separation, incapacity? Ensure that whatever structure you have in place, the business is protected and continues to run if personal circumstances change. And I would say that is absolutely right. This is a tax lecture, though, and so there is a limit in the time available to how we can go into that, those kind of issues. And I have mentioned a few of them, but yes, it is always something that, obviously tax is not always the key issue. It's a bit heretical to say that in a tax lecture, but tax is not always the key issue. And whatever you do need to make sure that all of the issues are considered. We then have the issue of disincorporation, and the point that has just been made about having a flexible structure is quite an interesting one, because there are definitely people that I've had discussions with over recent months where somebody has incorporated a business and then thought, you know what, I don't want to run through a limited company. What am I going to do? So what does happen if you decide that you no longer want to operate through a limited company, but you do want to carry on trading? We did used to have something called disincorporation relief, but that was abolished way back in 2018. And the story goes that the reason that it was abolished was HMRC issued a consultation document which said, we're thinking of abolishing disincorporation relief. Has anybody got any views on it? And not a single person responded to the consultation, which led HMRC to believe that it was not a terribly valid relief. To be honest with you, all it did was stopped there being any corporation tax liability on a disposal of assets by the company, but it was still treated as a distribution. If you are disincorporating because you are actually retiring, then you may be okay, but there are some pitfalls to overcome. So it is a cessation of the trade in the company. There aren't any particular issues, although there are some anti-avoidance provisions to do with things like terminal loss relief. Normally, when you cease trading, you can claim terminal loss relief. But the corporate loss provisions do, say if you're actually transferring the trade to a connected company, you don't get terminal loss relief. I think you'd probably be okay if you were transferring it to a connected individual, but which would happen on disincorporation. But again, you would need to check that. Obviously, any assets that the company have, it will be a disposal. Again, we've got the same capital allowances issues as we might do before. If you don't have any goodwill, if you don't have any business premises, then it's not going to be an issue. But any assets that you do get out of the company, it is going to be treated as a distribution to the shareholder. In most situations, you would hope that that is going to be a capital distribution and you'll get BADR. If the reserves are more than £25,000, then you have got to go by way of a formal liquidation, or you cannot get capital treatment. If your reserves are less than 25,000, you can just get the company struck off and still have your distribution treated as a capital distribution. That's used to be distributions which were under the old extra-statutory concession C16, although that was abolished in 2012, so it's an awful long time since that legislation changed. But the pitfall to getting capital treatment is the 2016 provisions, which extended the transactions in securities provisions, such that if you have a company that is wound up where the individual shareholder had more than 5% of the shares, where within 2 years of the winding up, they are carrying on the same activity, and the main purpose of the winding up was the avoidance of tax, then it is not treated as a capital distribution. So there is a misconception that I do find stated to me, that this is about whether or not business asset disposal relief is available, but it's not. If you are caught by this, it is an income distribution, not a capital distribution. So you would pay dividend tax rates, not capital tax rates. So you do have to be very careful. Now, the first three are probably fairly straightforward. Whether or not you are carrying on the same activity may be subject to debate. But the question is obviously often going to be whether the main purpose of winding up is the avoidance of tax. Now, again, we haven't had a lot of compliance work in this area. I suspect that it was introduced to try and stop phoenixing, where you have very aggressive procedures whereby somebody winds up a company and then starts another company doing exactly the same thing. But it may not be that straightforward. It's not possible to get clearance again on this point. And the Revenue have issued a spotlight on this particular point. A spotlight is where they highlight tax avoidance schemes that have been promoted that they don't agree with. And this is where you sell your business to someone else and then they wind it up. And HMRC says that they still think that legislation applies. Conditions aren't straightforward, and there isn't a lot of guidance in the Revenue's manuals about when or when it might not apply. But it is clearly something that you do need to think about. The other question that I sometimes get asked is, if we transfer our business and take our business out of a company or cease, what taxes can the Revenue collect? And it was actually a question I got asked quite a lot in relation to companies which were being wound up because of the changes in IR35, sort of way back in 2021. But HMRC can only collect outstanding corporation tax from a company if they can prove that, they can transfer it to the shareholders, they can issue a personal liability notice, but they would have to demonstrate that the corporation tax had been underpaid due to the deliberate behaviour of the company. So it would have to be a deliberate offence, and that is quite difficult for the Revenue to show. HMRC can collect pay-as-you-earn income, that relates to the shareholder or director themselves. But again, if you're talking about shareholders winding up companies, it's probably very rare to find that they are going to have any pay-as-you-win income. So unless you've got a deliberate situation like something like a phoenixing, then I think it is probably very unlikely that you are going to see the revenue. I mean, never say never, but it's certainly not something that I see very often. Anyway, we are going to move on and talk about IR35, but I have actually had a question. What do I think is behind the additional disclosure which will be required in the 25-26 tax return for dividends from closed companies? Does this herald a tax on Alphabet shares with different dividend rates? It is an interesting point because I have wondered that. I think that it might be more to do with situations where there are not different classes of shares, but dividend waivers are being put in place, which is still something that we do see quite often. I'm always quite surprised at the number of situations where the revenue are where dividend waivers are still being put in place in order to vote separate dividends. But I think that it might just be a data exercise from the revenues perspective to see whether they want to have wider overhaul of closed companies. Because there is still this perception that you get away with tax by voting dividends. They've obviously put up the dividend tax rates. But the fact that no national insurance contributions are charged on dividends is still, I think, something of a bugbear to the revenue. I think it is going to be a data collection exercise whereby they then have a look at the data and decide where they go next. I don't think it is inevitably going to be an attack on Alphabet shares. But again, and so, that is a possibility. I think the revenue often have ideas about various things, and they seek to collect data in the first instance and then decide what it is that they are going to look at. But yeah, it is an interesting one. I'm increasingly finding that I don't understand anything that the revenue do, so I'm possibly not the right person to ask. That is possibly also an indicator that I really ought to retire. Anyway, let's move on and talk about IR35. Now, it's always difficult when you talk about IR35 because there are lots of people who say, oh, I never have anything to do with this anymore. It's a waste of time talking about it. But I do still get questions about it. I do still get people who are, having to deal with IR35 type issues. And I think it is going to come back. And one of the reasons I think it is going to come back is because we are seeing changes from the 6th of April this year into the tax treatment of umbrella companies. So IR35 applies, as we will see in a minute, where you have an individual worker working for an end client through an intermediary, which is often their personal service company. And IR35, the anti-avoidance provisions were introduced in 2000 because HMRC perceived that these were being used quite widely to avoid pay-as-you-earn on payments to workers who were effectively employees. Now, from 2000, the burden of deciding whether IR35 applied fell on the intermediary, on the personal service company. And what we saw in 2017 and then 2021 is that the compliance burden shifted to the end client, unless the end client was a small company or had no business within the UK, in which case the compliance burden remained with the intermediary. And whilst those changes meant that many businesses decided, particularly bigger businesses, decided that they would no longer engage with personal service companies, and often pushed down into umbrella companies. I do think that, as I've already said, we do still see a lot of personal service companies. And second, I think the change in the umbrella company regulations is again making people think. And just in very broad terms, actually, I'm going to talk about umbrella companies at the end. We've also had a lot of case law, mainly relating to people loosely within the entertainment industry. But it is also interesting, I think, perhaps from a little bit of a geeky perspective, but quite interesting to consider where we are with that case law. Now, before I go on and do that, just a note to say that the definition of a small company is changing. As I've said, if the end client is a small company, then the personal service company becomes responsible for IR35 liability. But with effect from April 25, the definition of a small company changed. It won't become effective until this year because you're looking at last year's accounts. But basically, you are a small company if if 2 out of the 3 conditions are met: turnover not more than 15 million, balance sheet of not more than 7.5 million, average monthly average employees not more than 50. The number of employees test is not changed. Turnover has gone up from 10.2 million, balance sheet has gone up from 5.1 million. So there may well be people who are working through personal service companies for a company which was not a small company, but will now be a small company, and therefore compliance obligations may change. Okay, so the basics of IR35, as I've already said, you have a worker providing services to an end client via an intermediary. That intermediary is most often a company, but it could be a partnership or even an individual. But the legislation will only apply in situations where the worker would have been an employee if there was a direct relationship. And that part of the IR35 legislation did not change in 2017 or 2021. And theoretically, the factors that are used to determine whether or not somebody is an employee are exactly the same as would be considered if there was a direct relationship. So if the worker was working directly for the employer. But in reality, that is not strictly correct, because if you have a worker working directly for a client, you have one relationship to consider. With IR35, you have the relationship between the worker and the personal service company. There may be an agency involved. So you might be talking about a relationship between the company and an agency, and then the agency with the end client. You could have more than one agency. You could have a direct relationship. So working out what the exact relationship is not necessarily going to be straightforward. And that is why when we are looking at IR35, it is so problematic in terms of how we come up with the answer, which is the right answer. So, that is why we have, to a certain extent, so many disagreements with or potential disagreements or potential grey areas when we are talking about IR35. So, as I've said, significant number of cases, all of them considering the status aspects of IR35 and considering whether the workers should actually be treated as employees. Now, we have settled into a pattern where the courts are considering principles established by a very old case involving a company called Ready Mixed Concrete. Now, this was actually a social security case heard in the 1960s. So it is pretty much 60 years old. I think pretty much 60 years old now. In that case, it was established that there are 3 tests that need to be considered. Does the end client control the worker? Is there mutuality of obligation, which broadly means that the worker the end client will offer work and the worker will accept it. And there will be payment involved. And then, is there anything in the contract which is inconsistent with employment? So if any one of those tests is failed, then you are not an employee. And in the ready-mix concrete case, we had, as the name suggests, a company producing ready-mix concrete. And they had an individual who was a delivery driver who was self-employed, where it was found that there was control and it was found that there was mutuality of obligation. But within his employment contract, he had a right to send a substitute. And it was a real right to send a substitute because he had actually sent a substitute on occasions. And that was found to be inconsistent with employment, and therefore he was not an employee. Now, the factors in the contract which might mean that overall it is inconsistent with employment could be substitution rights, or it could be something else. And so when we look at the kind of cases and how it might be applied to different scenarios, we have got to look at different aspects. Most relationships are going to be cases where there is sufficient control and where there is mutuality of obligation. That's particularly true in the tax cases that we've had, but will often be true in other cases as well. In the cases we've had, there is control because you have to comply with very strict Ofcom obligations, and mutuality of obligation often exists where there is a contract in place. So it is always typically coming down to this final point as to whether or not there is anything that is inconsistent with employment. So that's where we can look at a couple of cases. I'm not going to go through all of the cases that have been heard, but a couple of the cases are quite important in terms of where this goes. Kay Adams is a case which is important, mainly because it was such a long case. Kay Adams is somebody who you may have heard of, you may not recognise immediately the name, but you would probably recognise her if you saw her. She appears on television. She's been in Loose Women. She was on Strictly, but she does after dinner speaking. She writes books. She writes a newspaper column. She has what is probably the definition of a portfolio career. But this case involved a 2-year period where she was presenting a weekday programme on BBC Radio Scotland. So I think she presented 9 until 12, Monday to Friday, something along those lines. And the revenue believed that even though she had lots of other clients and lots of other income sources in relation to that particular engagement, she was an employee of BBC. So the main facts were that the BBC did not have first call on her time, and she did not need to seek their permission to work anywhere else. She had no entitlement to holiday or sick pay, so if she didn't work, she didn't do her show, the BBC would find somebody else to do it, but she would not obtain any holiday pay, and she certainly wouldn't get sick pay. She had no entitlement to receive a pension. She wasn't subject to formal procedures, so if if there was any sort of suggestion that she had breached protocol, then she wouldn't be subject to the same procedures as an employee would be. Her contract might well be terminated, but otherwise. And they had a particular regime where existing employees could apply in priority for internal vacancies, which she wasn't allowed to do. Now, the first tier tribunal found she was outside of IR35. The upper tier tribunal found she was outside IR35. The Court of Appeal decided that the first two courts had not thought about the ready-mix concrete correctly, and so they referred it back to the first tier tribunal, who again found for her. HMRC then said, we don't agree with the decision, but we're not going to appeal it because we've already had 4 tax cases, which I don't think is really a very generous decision. Well, I mean, it's generous not to appeal, but I thought it was a bit mealy-mouthed for them to make that. But the fact is, she was controlled. She did have mutuality of obligation, but there were enough other things in her contract which meant that she was not caught by IR35. So it is possible to make those arguments. We had another case involving Lorraine Kelly, which was actually the first notable success for the taxpayer in these, but was a very different type of decision. And in that case, it was found that actually she wasn't supplying a service to ITV. So this is Lorraine Kelly, who has a programme on ITV in the mornings called Lorraine, which I guess nobody on this call will have ever seen because they would have been working. But they actually found that IR35 only applies to services. It doesn't apply to brands. And so she argued that the person that you see on screen is not Lorraine Kelly. It is a brand pretending to be Lorraine Kelly. And so she is providing that brand. Indeed, there was effectively no control by IR35, so by ITV. So again, that was unusual. But again, it's an interesting case if you want to look at it. So where does that leave us? In reality, little has changed. We still have the situation that bigger companies are not wanting to use personal service companies, but effectively, they may well be forced to do so. But we do still have many businesses dealing with it. HMRC are doing a little bit of compliance on this. So in some ways, it might be low risk. But again, it can be quite difficult to give a decision as to whether a contract is categorically out of the regime. So it is still not a helpful area. Just before I move on and talk about the CEST, a question has come in. Where the top company determines that a contract through a personal service company is not caught by IR35 and provide an HMRC evaluation on this basis. Our client has the personal service company. Do you revisit the IR35 valuation, or would you just accept it? So if the top company decides that IR35 does not apply, then if they are wrong, they are going to be liable to the tax. So if they are happy that that is the case, then the risk lies with them. And so I would say that probably in most cases, you would just accept that. If it was the other way round, if they did an evaluation and decided that IR35 did apply and that they were going to deduct tax and you disagreed, then you can challenge that valuation, you can challenge that assessment. Although, ultimately, again, I suppose the risk lies with the end client, and they may well not be prepared to do that. But yeah, that way round, it would probably be worth challenging, but alternatively, probably not. Okay, so the CEST is the Check Employment Status tool. And this is what we are supposed to use to determine the status. It was February. It was sort of this time last year it was changed. I think it was the 30th of April 2025. And as a bit of a geek and somebody who does advise in this area, I was quite excited that the CEST was going to be updated. Very sad, I must confess, because I thought for a while that it wasn't very good. It didn't really give you a very good answer. But in reality, I think there were only about 4 changes and they were all very minor. And so that was quite disappointing. But actually, what they did do before they updated the CEST was they changed the guidance. And the CEST now very much points users towards the guidance. And if you look at the way that the guidance is presented, it is very much now skewed towards getting a positive decision. So that is that you are an employee. And I have done a little bit of an exercise with it when it was changed, going through comparing what the guidance said before, comparing decisions that I'd had before, where I think that the updated CEST is not necessarily helpful. And I don't think it's right. I'm not sure that in some of the cases the guidance is actually right. So, again, it is one of those areas where there are some question marks about the direction of travel, really, and where we are going with this. So if you do have clients who are working through personal service companies, I think you have to take a fairly pragmatic approach as to how you are going to deal with this, looking very much at how, what there is in the contract. I must confess that, a lot of the cases I see, I do feel that you are going to struggle to defend it in front of the revenue if they were to challenge it. But, again, we are not seeing a significant number of challenges. So, maybe it is relatively low risk, but, everybody's got to make a decision on that point, really. So just for completeness, I've mentioned a couple of times already this morning that there is a change in the legislation for umbrella companies. So just again, for the avoidance of doubt, really, an umbrella company is kind of a bit like an agency where they engage individuals who are then supplied as workers either via an agency or directly to an end client. And those individuals are employees of the umbrella company. And so when large companies decided that they did not want to engage with individuals through personal service companies, what they did do, they effectively state that, they push you down into using an umbrella company. But umbrella companies have been used very widely in the past for tax avoidance, not all of them, but a lot of them for tax avoidance purposes. And they are often situated offshore, places like the Isle of Man, which means that if the umbrella company either doesn't deduct pay-as-you-earn or doesn't remit pay-as-you-earn deducted from individuals' salaries, then HMRC are going to struggle to actually collect it. And so what the new legislation is going to do is basically mean that people within the supply chain, so where you have an umbrella company, an agency, an end client, people within that supply chain may become joint and severally liable for pay-as-you-earn on payments under those arrangements. And effectively, what you might have is somebody who is engaging people through an umbrella company who will become liable for tax that is due and payable but has not been remitted or paid by that umbrella company. And so anyone who is engaging through umbrellas is now going to find potentially there is going to be an exposure. Relevant parties, so those are the people who are going to be potentially liable is very widely defined, and the legislation is incredibly complex in terms of who is liable in priority and the circumstances where you might be liable in priority in different cases. And again, that is going to be something that we will need to consider quite closely. It also can't apply to any company where the worker has a material interest. So if you were a company that fell within IR35, this typically not going to apply. There is also a lot of anti-avoidance legislation tied up with this. So it is not straightforward legislation, but clearly I think we could have a shift. Now, whether that is these businesses are going to, give up the ghost and say, we're just going to employ people directly, whether they are just going to do more due diligence on whether they think that the umbrella company they are using is going to be compliant or not, I don't know. But I suppose it is just something that where we might see a shift. If we have a company, so questions come in, if we have a company that employs all of the staff for a group, they are paid from company A but do work in company B and C depending on the contract, all companies are related under the same ownership, will this be caught by the new umbrella rules? No, it's not. You wouldn't be caught in that situation by IR35 because there is a specific preclusion, and that would not be considered to be an umbrella company in this context. So again, that is going to be fine. There is not going to be an issue with that. And this must be complicated legislation, because normally when we get the finance bill published, parliamentary draftsman has put in place provisions which they consider to be relevant based on what the policy objective is of the government, and it goes through Parliament and then will emerge with very few amendments. This current finance bill emerged with very few amendments, but all of those amendments related to the umbrella company provisions, all of the substantive amendments, anyway, almost all of the substantive amendments related to the umbrella company provisions, where there were additional tweaks made to the kind of companies that might be caught and the ones that won't be caught. So I think it is going to, I think straightforward situations where, you have an umbrella company, you have an agency, you have an end client, I think that those are going to be fairly straightforward. But I suspect that umbrella companies will also be trying to see if they can put in place arrangements which will circumvent the new rules. So, again, if you have got clients who are working through umbrella companies, you need to check any changes that are made to make sure that they are not going to be caught. Now, I said I was going to talk about the associated companies rules. I'm just going to talk generally about corporation tax, the rates and so on, and then we'll have another break, and then I'll go through the associated company provisions. As I've already said, the general provision is that a small company will pay, a company will pay small company rate of tax of currently 19% up to profits of 50,000. Main rate above 250,000 with marginal rates in between that. And the rate at which those 50,000 and that £250,000 threshold is reduced if you have a short accounting period or if you have associated companies. Now, this was introduced, or this changed in 2023, but it basically picked up the same provisions as we had in the past when we'd had different rates of corporation tax. And effectively, we can look back at those previous provisions, but a lot less companies were affected under the old rules because the small companies rate was paid up to 250,000 and you didn't get the main rate until the profits were 1.5 million. So reductions in those limits did not impact small companies in the way that these do. The other thing to note is that certain companies are always going to pay the main rate of tax, but there is a double whammy because they can still reduce the rates because they are still associated companies. Two main types of things you might come across are close investment holding companies or overseas companies. So a company that is based overseas but is paying tax in the UK, typically on property income, will be subject to tax at the main rate, as will close investment holding companies. When we are looking at associated companies, we do not have to take account of what are called non-trading holding companies. So if you have a holding company in a group which has no activities itself, simply receives dividends from the subsidiaries and passes those on to their own shareholders, that is not taken into account. Just for completeness, let's talk about close investment holding companies. You've got to be a close company in the first place, which is a company that is under the control of 5 or fewer individuals. All close companies are close investment holding companies unless they are trading, they are renting out property, unless they are renting out to connected parties, or they are a group holding or financing company. And so most businesses, trading businesses, property investment businesses are not going to be close investment holding companies, but you do have tweaks to that. So if you had 2 standalone companies, one that had the trading activities and the other that had held the property from which the company trade, but they were not grouped, the property company there would be a close investment holding company, but you would still have 2 associated companies for the purposes of the limits for the trading company. It is wholly or mainly that we use for looking at these activities. So, for example, wholly or mainly renting properties to connected parties and so on. So, again, you need to be careful about that. I do still see a lot of issues with close investment holding companies. I do think that people do not necessarily understand where they apply. Okay, well, I may make it, it's just ticking up to 10:57. So quite a convenient place to stop. So we will come back at 11:05. So we will have our second break now. Okay, welcome back. I have had a question come in, but I'm going to leave that until I get to the end of the section, if you don't mind, because that it's probably easier if I do the explanation and then come back to the question afterwards. Okay, so associated companies, as I've said, associated companies reduce the corporation tax, the point at which high rates of corporation tax apply, and therefore are going to be incredibly relevant. Companies are associated where they're under common control or where one controls the other. And for the purposes of this legislation, control is either exercised through share capital, voting rights, rights to income, rights to capital on a winding up. And one of the reasons that control or the associated companies provisions are so complicated is that control has no chronology. So we don't say, okay, we first look at share capital, and if somebody controls it through share capital, nobody else can control it in any other way. So you could, for example, have a company where 50% of the shares were held by somebody who had voting rights and rights to income, and somebody else had 50% of the share capital that had no voting rights but had rights to income and rights to capital. and it will be jointly owned by the two of them through share capital, it would be controlled by one because of rights to capital, and then it would be controlled by another by voting rights. So you could have three different combinations of people who control the company. Control can definitely be exercised jointly. And what we are always looking at in determining control is something called the smallest irreducible number of people that can control a company. So if you had a company where 51% of the shares were held by Mr. A and 49% were held by Mr. B, the smallest irreducible number of people who can control that company is one. That's Mr. A. The company could be controlled by A and B jointly as well, but it's actually controlled by A because that is the smallest irreducible number is one. So we're always looking for this smallest combination. And once you get down to that smallest combination, even if control can be exercised by a different, larger group of people, that would not be relevant. I'm going to have a look, go through some examples, and hopefully we will see this in a moment. However, there is a complication because of attribution of rights of associates. So this is where we are looking at whether or not family members or people are treated as if they own the shares of other people. However, you only have this where there is commercial interdependence between companies. And you always have to start off by understanding what we mean by control and where there might be an issue. So I want to go through a few examples, and then we'll talk about what we mean by commercial interdependence, and therefore consider when we might get attribution of rights of associates. So this is the first example. Here we have husband and wife shareholders. Each of them own 50% in company A and 50% in company B. Those companies are associated because they're under common control. We don't need to worry about whether or not they are commercially interdependent because they are already under common control. The same would be true if we had exactly the same split between an unmarried couple, or indeed just two people who happen to be in business together. Don't have to be a couple at all. But those two companies are associated because they're under common control. However, it is different where we have a situation where one party, husband and wife in this case, one party controls the company on their own. In this case, we have the wife controlling company A by virtue of owning 51% of the shares, husband controlling company B by owning 51% of the shares. Now, on the face of it, they are not under common control. But this is where the attribution of rights comes in. Attribution of rights means that you are treated as if you own the shares of somebody who you are associated with. And we'll look at who the associates are. And there's a bit of an overlap of terminology, which isn't helpful necessarily, but we'll talk about that in a minute. So if you attributed the rights of the wife to the husband, or the husband to the wife, you could end up with both company A and company B solely being controlled by that person. But we would only do that attribution if they're commercially interdependent. And as I say, we're going to look at what we mean by commercial interdependence in a minute. If we go back to our unmarried couple, where the common law wife owns 51% of the shares in company A and the common law husband owns 51% of the shares in company B, they are not going to be associated, even if they are commercially interdependent, because unmarried couples are not associates, and therefore there would never be any attribution of rights from one to the other. If you had husband and wife plus their son in one company, husband and wife have 50% each in company A, husband and wife and son have a third each in company B, the smallest irreducible number of people who can control company A are the husband and wife. 2, the smallest irreducible number of people who can control company B is 2. It could be mum and dad, could be mum and son, could be dad and son. But the fact is that one of those options is mum and dad, the same two people as control company A, and therefore, again, they are going to be under common control and they are going to be associated excuse me. I ate an almond during the coffee break because I felt I needed a little bit of energy. It's a mistake. Anyway, they are always going to be associated because they're in common control. However, if we had first company controlled by mum and dad, and then you had mum and dad and 2 kids, each with 25% of the shares, in company B, the smallest irreducible number of people that can control it is 3. So if they are not commercially interdependent, they are not under common control. But if they are commercially interdependent, then the son's shares or the kids' shares could be attributed to the mum and dad, and therefore they would be under common control. So it is vital to understand complications of this. So one of the things you've got to be slightly careful about is something like a casting vote might give control. Or if you have directors' loan accounts, such that capital on winding up becomes the determining factor on whether or not something is going to be associated. Although loans between companies are not normally taken account of in determining control, but they might in determining commercial interdependence. Now, whose shares do we attribute? Within a family, parents, grandparents, remoter ancestors, children, grandchildren, remoter descendants, brothers and sisters, spouses or civil partners, or spouses or civil partners of any of the above. Business partners. So if you are a member of an LLP with a group of unrelated people, you are still associated with all of those people. And trustees of a settlement where you have an interest. But the complication is typically family. Now, what do we mean by commercial interdependence? There are 3 categories that we look at. Financial interdependence, economic interdependence, and organisational interdependence. Financial interdependence is one gives financial support to the other, or each has a financial interest in the affairs of the same business. That should be quite straightforward. Economic. Actually, before I go on to, let's have a look at an example on financial interdependence. This comes from the revenues manuals. So L is the major shareholder and director of company M, a large road haulage company. P is a sole shareholder in Q, which is set up from scratch and runs with his wife. Company Q occupies property that's owned by his dad or his parent, paying market rent. In that example, HMRC considers that there is no obvious financial link between the companies because market value is paid. Because it is on market value terms, they're not associated, even though they could be attributed. So that's financial. Economic, companies seek to realise the same economic objective. The activities of one benefit the other, or they have common customers. Now, the phrase companies seek to realise the same economic objective to me seems pointless, because what on earth does that mean? Surely the economic objective of every business is going to be that you make a profit. Anyway, the activities of one benefit the other, or you have common customers. The example that we can look at from the revenue manuals, Q is the major shareholder in company C, which runs a large Chinese restaurant. It also operates a Chinese supermarket. The wife is a chef trained in France who is the sole shareholder of a company which runs a restaurant she has built from scratch. Although they are husband and wife and in the same trade, there is no link between the two companies. Therefore, they are not associated. And then organisational interdependence, common management, common employees, common premises, common equipment. I think that is the one that the revenue treats most strictly. Sorry that this is such small writing. So Dad is director and sole shareholder of one company. He and his sons are directors and shareholders of another company. They both operate through a builder's yard. Basically, and it is the dad who owns the premises. The dad's company operates the trade counter, is the wholesaler. The joint company is a retail counter, has its own access and parking, but buys stock from his dad's company. They have separate phone lines. A commercial rent is charged. There's a division of overhead costs. Wages of common employees are split. Separate tills, separate bank accounts, own vehicles. HMRC's view is that there are significant organisational and economic links between the two, so they would be associated. They basically say the retail business could not operate without the wholesale side. I quite significantly disagree with that analysis because, you know, if that retail side was, I mean, that could be run by a completely separate company, or the retail side could be getting its goods from another wholesaler. So that is the one I think where we have the most issue. Now, loads of questions coming in, not that I am supposed, you know, and not that I am, I'm surprised. So I have a client that owns a company with a mix in commercial and residential property. This is not VAT registered. He has another business, which is a tenant of the property company offering IT services registered for VAT. Is this classed as an associated company for tax? If he owns 100% of both companies, they will be associated. Because, as I've already said, the issue of whether or not there is commercial interdependence is not relevant. They are under common control, and so they are associated companies. Supplementary question, is he also caught under the ATED provisions? Well, the company that is renting out the residential property, if any of those residential properties are worth more than £500,000, then theoretically they'd be within ATED. But if they're renting them out on an arm's length basis to unconnected individuals, then presumably they'd get a relief, but they'd still have to put in a return. If a company is controlled by an individual by virtue of holding 100% of the issued share capital, and he is a trustee of a trust along with two other trustees, which holds 100% of the issued share capital of another company, are those two companies associated? If we go back to this slide, it will only be if he has an interest in the trust as well. So if he has an interest in the trust, they might be associated companies, but only if there was commercial interdependence. Because that is a situation where you would have to be attributing the shares in the trust to the individual for them to be controlled. It wouldn't be automatic. And you would only do that attribution if he actually had an interest in the underlying assets of the trust. So he was a beneficiary of some description. Commercial interdependence. If trading with each other and external parties, are they commercially interdependent? Well, you can see from that example on organisational interdependence that HMRC believe that you can be commercially interdependent even if you have a very robust trade with third parties. And then a supplementary question is, sums only taken into account if minors? And the answer is no. Anyone who is a family member, again, anyone who is a relative within that definition, is taken into account for these purposes. Doesn't matter what their age is. The activities of one benefit the other. Is there a percentage threshold? No, there isn't. I mean, you are grading on a scale. Then, yeah, they are grading on a scale. So obviously, the higher the benefit from one to the other, the more likely they are to have an association. But no, there isn't any percentage threshold. And it's no surprise, really, that the revenue don't have a percentage threshold. What if two people, not a couple, own 50-50 of two companies? One is a trading company, one is property rental. Would they count as associated even though they were completely separate with separate trades and were not set up to spread profits in any way, purely because they're under common control? Yes, the answer to the question is yes. So again, going back to example 2, unmarried couple own two companies 50-50. Doesn't matter what the activities are of those two companies, they are associated because they're under common control. So yeah, again, you've got to be very careful. If companies share premises but are completely different types of businesses, do you think they would be associated? So this was a question here. I mean, this question doesn't seem to imply that the dad's company is also owning the same, occupying the same property. But it seems to suggest that if market rent is paid, then you'd be okay. Although the final example we looked at seems to contradict that. But you know, I think that there were more links there that the revenue were thinking about. Now, so I don't think they would be associated. The one that is often quoted by the revenue, on which I do get asked questions about, is if we go back to this example, and sorry to keep flicking back and forward, but I think it is quite useful to have something to stare at really when you're talking about this. In this situation, what if husband and wife were both directors of both companies? I would say if they were just directors and didn't really have any other involvement in the running of the businesses, Because there is a good reason to have two people as the director of a company. Because if you've only got one director and they die, then there can be some situations where you can't appoint, where the existing shareholders can't appoint another director, and so the company can't be run. So if in this situation the wife was a notional director of one company, the husband was a notional director of the other, that wouldn't, I think, make it commercially interdependent, but that point is not conceded by the revenue. Unmarried couple who own 50% each of a company, but then 100% each of their own company, are these associated? No. And it wouldn't matter if they were commercially interdependent, they would not be associated. Surely, if financial is true, companies paying market rent would not be commercially dependent, even though both companies benefit from the transaction as both profit from them. Assuming that company A buys services from company B. I think that if you had market rent being paid, but then there were other reasons why they might be commercially interdependent. I mean, I think that you're probably alluding to this example that we've had at the end here. I kind of disagree with the revenue on that one, that if you are trading as two independent businesses, now in this case, they may be implying that there is kind of, well, what they say is the existence of one underpins the viability of the other. Now, the phrase underpins the viability of the other suggests to me that what they're saying is that one would not be able to function if the other one didn't exist. Then in that situation, I don't think that is necessarily evident from the issue. So another example has been given: A sells courses and buys staff from company B to deliver them. I mean, I wouldn't say that would automatically make them commercially interdependent, but it's obviously quite nuanced. And I don't think, and these are not the only examples that are in the revenues manuals. There are other examples, and you can take from that the nuance involved in it, but it's definitely not straightforward. And then someone said the activities of one benefit the other a percentage threshold. Could I repeat the answer to this one? No, there isn't a fixed percentage threshold. You would be looking at a range of different, it's not binary. It's not going to be something that is easy to determine. You have to look at all of the facts and decide on the basis of those facts whether you think that you have an argument or not, looking in the round at all of the connections between the companies. But somebody did make a very good point in terms of if there is no artificiality and you haven't deliberately split the businesses into two in order to get a reduced rate of corporation tax, you can still be associated even if there is no motive test involved in any of this, which is why it is quite difficult and why clients will often be really quite aggrieved at the thought that they are going to have a corporation tax liability problem. Now, and of course, some people will have set up businesses on the basis that it didn't matter how many companies they've got. I have got a client who is, I think, probably my worst client because he is an absolute nightmare for doing things without asking me, who has a number of property rental properties. And he made the decision that he was going to put each of those properties into a separate company. And so he's now left with a situation where each of those companies has got 15 associated companies. And therefore, I'm not sure I can quite work that out in my head. But the point at which each company starts to pay marginal rates of tax is incredibly low. It's going to be about £3,000, isn't it? 3,000 and change. So again, that was the business model he chose to adopt, because at the time he chose to adopt it, it didn't actually make any difference. And then he complains every year about how much it costs him to have accounts and so on made. But anyway, there we go. But it's definitely a difficult area. Okay, two couples own shared in the following order. Oh God, this is a complicated one. Husband of first couple and wife of second couple are director, 50% equal shareholders of company A, and wife of first couple and husband of second couple of directors, 50% shareholders of company B. Would they be associated? There is no commercial interdependence, but both companies carry out similar trades. They would only be associated if there was commercial interdependence, because if there was commercial interdependence, the shares of each couple could be attributed to their partner, their spouse. So you could end up with the husband of the first couple and the wife of the second couple actually holding the shares in company A and being deemed to own the shares in company B. So as long as you are confident that there is no commercial interdependence, even though the companies carry on a similar trade, then they wouldn't be associated. Right. Pause just in case there's any final questions on that point. Okay, capital taxes issues. Oh, I think you mentioned if company A owned 100% by B, company C owned by D, B and E not related. That if you set up company E, which they own 50-50, then they're related, even if there is commercial interdependence. No, they wouldn't be. If B and D are not related and B owns 100% of one company, D owns 100% of another, and then they set up company E, which they own 50-50. Company A is controlled by B. Company, yes. So they would not be connected, associated, sorry, even if there was commercial interdependence. Right. Good. It is not a straightforward. It's not a straightforward question. I was doing a lecture on associated companies at one point, and I'd got this really what I thought was a really eloquent example with lots of different companies, with lots of different people involved, some of them related, some of them not. And I'd got this lovely table where it showed which companies were connected and which were associated and not associated. And halfway, and I looked at it and I checked it and I'd gone back and I thought I'd nailed it. And I was giving the lecture and realized that it was wrong. So it's not an easy area. Right. Capital taxes issue. So I suppose this is thinking about whether or not there are any structuring issues in terms of the capital taxes treatment. And when we're talking about capital taxes, we're talking about BPR, APR, business asset disposal relief. I mean, business asset disposal relief is still important for some people. Obviously, as we've already talked about, the lifetime limit is only £1 million now. The rate of tax is going up to 18% from next week. And so the maximum benefit you are going to get is £1 million at 6%, but that's still £60,000. You can go on a nice holiday for £60,000. So, you know, it is still important. So we are seeing increased compliance work from the revenue. We've had a few tax cases that I'm going to talk about. But broadly, you are going to get BADR if you have shares in a qualifying company, you're selling all or part of an unincorporated business, and that would include selling a partnership interest, or where you are potentially holding a property outside of a company or a partnership. The rules are much more nuanced, but you can sometimes get business asset disposal relief on that. So you do need to make sure that you meet the conditions and you're not going to do anything which destroys those conditions. You have to meet the conditions for 2 years up to the date of disposal, or up to the date of cessation, if the company ceases trading. And then you have 3 years from the date of cessation to liquidate it. So if we're looking at, share sales, three sets of conditions that you have to meet. You've got to be an officer or an employee. It's got to be a trading company or holding company of a trading group. And you've got to have 5% of the shares, 5% of the voting rights, and then a rights to 5% of the income and right to 5% of the capital on a winding up. Although 5% of income, 5% of capital can be overridden if you are entitled to 5% of the proceeds on a sale. And that was to sort of get round the problem with alphabet shares. So whether or not you own 5% of the shares, again, and you meet those conditions should be a matter of fact. Checking to make sure you meet the conditions is obviously always important. We had a tax case a couple of years ago where a couple had 6% of the shares. They were about to sell the company. They took advice from their accountant that they would get entrepreneurs relief. So it must be more than a couple, or the case was a couple of years ago, but that they were going to get entrepreneurs relief on the disposal of the shares. But then before the deal went through, they transferred some shares to another shareholder. So they only had 4% of the shares each and forgot to tell the accountant and forgot to get additional advice on it. And therefore, they no longer met the condition. Trading company or holding company of a trading group. To be a trading company, you have got to be wholly trading or have non-trading activities which are not capable of being substantial. And the measure of substantial in this context is 20%. So going back to the observation I made earlier on about cash accumulations in companies, it does say in the revenues manuals that if you have cash accumulating in a company and it reaches more than 20% of the net asset value of the company, then it could prejudice the trading company status. But in reality, I think the risk there probably lies only with a situation where you're actively managing that cash. So you are lodging it on the money markets overnight, or you use it to buy investment bonds or something along those lines. Money that is just sitting in a vanilla deposit account earning a tiny amount of interest is probably not going to make too much difference. And again, whether you are an officer or an employee is a matter of fact. Whether you're an officer is a matter of public record. Whether you are an employee is again a matter of public record. My favourite, and as I say, if the company ceases trading, you have 3 years to liquidate your shares. But the other two conditions have to be met all the way up to the date of disposal. And my favourite AI clanger to date, I'm keeping a record of things that are referred to me where people have asked questions of AI and AI has got it slightly wrong, is where AI was asked whether somebody who had ceased to be an employee and then sold their shares after that date would be eligible for BADR. And AI told them that as long as they sold the shares within 3 years, then they would get BADR on the disposal, which is clearly not correct because, as I say, you only have that 3-year window once the business has ceased trading. Now, going back to the observation we made about clearance applications, at one stage it was possible to write to the revenue and ask for clearance from them that a company was a trading company, but that is not really something that I would necessarily advise. And the reason that I would not necessarily advise it any longer is that the last few that I've done, they've just come back and said no. I was fairly confident that they were trading companies, but the client wanted to go for clearance to get belt and braces. They've now come back and said no. And if you declare it on the tax return, but you disagree with a pre-clearance application, you've got to put that on the tax return. which will immediately, I think, flag it up for an inquiry. Whereas if you genuinely think it qualifies, you can just claim it, and then the revenue would have to pick it up in their normal risk assessment. So I wouldn't recommend going for clearance on the point about trading companies. So let's have a look at some of the tax cases that we've had recently. This was 3 individual shareholders who were shareholders in a company called SGL. They acquired the land and buildings that represented the former HQ of a company called GlaxoSmithKline in Greenford in Essex. Big site, very, very big site. Now, when they acquired it, it was what is called protected land, which meant that the government had put a protection order on it because they wanted to have an input into what happened to it. Because it was such a large piece of land, they basically wanted to have control over how it was developed. And so because it had this protection order on it, the company initially put it into investment. It was later agreed that it was going to become a mixed-use development, so they were going to build commercial, residential, schools, blah, blah, blah on it. I think there might even be a new university on it. But anyway, that was what it was. And at that point, the company appropriated that into trading stock. They then went ahead and got planning permission to develop it, but didn't do the development itself. They sold it to a third party, the land to a third party, put the company into members' voluntary liquidation, claiming that they had started trading when the land was appropriated and therefore entrepreneurs' relief was due. HMRC denied the claim and the company appealed. And effectively, this was one where the first tier tribunal looked at all of the badges of trade and decided that at no point did the company start to trade. They acknowledged that the land had been appropriated to trading stock, and they were also very much influenced by the fact that the director in this company kind of dropped a bit of a clanger in his witness statement by saying that realistically they were never going to develop the property themselves. It was just too big. They bought it really to churn the uplift on getting planning permission. So negotiating with the government and getting planning permission. They were never ever going to be in a position financially to bankroll the development of the property. And therefore, the first tier tribunal kind of came to the conclusion that they had never traded, and therefore the appeal was dismissed. They didn't get entrepreneurs' relief on the disposal of the shares. The next one was to do with a company that had quite a complex business. They owned the rights to mooring sites on the side of a river. And so they then rented them out to people who had houseboats and others. Those people who were moored there paid mandatory maintenance fees, which was a fee, for the fact that they were connected up to the utility, the fact that the marina had security 24 hours and so on. But they then also had a business whereby they offered repair services both to the people who were moored up, but also anybody could come along and ask them to do repair work. So they had rent from the moorings, trade of boat repairs, and then these maintenance fees. Now, we were talking about the fact, and then there was a lot of faffing around with new subsidiaries and so on. But the ultimate thing was that the shares were sold in this company, and they claimed entrepreneurs' relief. And going back to the point that we were making earlier on about a trading company being one that is at least 80% trading, HMRC's view was that this company was not trading. Their view was that the mooring income was not trading income, but also that the maintenance charge was not basically trading income. And so if you took out the mooring fees were kind of less than 20% of the total. But when you added in the maintenance fees, it represented about 70% of the overall turnover. And on that basis, it was found that it was not a trading company because of the nature of the activities. And then again, finally, another property development company. This was a company that was formed simply to loan money to a third party. Don't know why they did it through a company, but they decided to loan money to a third party. And they were loaning it to the third party to finance a property development. And at that stage, it was agreed it was an investment activity. But the third party couldn't repay the loan. And therefore, it was agreed that they would take the property in exchange for writing off the loan. They recorded it as an investment asset as it was going to be let out. But then they realised that they were never really going to get their money back just on renting it out. So they decided that they were going to try and develop this property. They they took out an option to acquire some adjacent land. They granted a separate option to somebody to develop it, and they applied for planning permission. They then sold the shares and claimed entrepreneurs' relief on the disposal. And again, HMRC denied it on the basis that the company was not trading. The first-tier tribunal were happy that they were actually trading, because the definition of trading for the purposes of BADR does include any period before trading commences. But the bottom line was that they were receiving rental income, and that represented 100% of the income that this company was receiving. And because it had historically been an investment business, the non-trading activities were substantial, and therefore it was not a trading company. So the appeal was dismissed. So a handful of cases there which demonstrate that HMRC are really tightening up on this, and therefore you do need to be a little bit careful. Somebody has made the point, if the father transfers shares in a trading company to his son, signs a holdover election, and the company is sold 6 months later, presumably the son will not get BADR. That would be right, because the son will not have held the shares for the requisite 2 years. The only thing that you could do in that situation would be to rip up the holdover election before it's submitted to the revenue, if it hasn't already been done, and actually get the gain to crystallise on the dad, because then the son would not get. I mean, I suppose there is an argument potentially in that situation that the value goes up between the transfer and the point at which it's sold, but you would at least get a bump in the market value up to the valuation at the date it was transferred. But obviously, if you've already submitted the holdover election, it can't actually be withdrawn. So, again, but you would be right in absolute terms. And, there are many occasions when people have undertaken transactions and then been given an offer they can't refuse. And just a reminder, though, that if you do a share-for-share exchange where you swap shares in one company for shares in another, you do look backwards through the date of the exchange in order to work through, in order to see whether you meet the 2-year holding period. So if you'd put a holding company above an existing trading company and then a year later you sold the holding company, then that would be okay, as long as you'd held the trading company shares for more than a year before you did the share for share exchange. IHT, obviously increasing focus on IHT. We've got lots of changes announced in the budget in 2024 that are coming in over the next few years. BPR, APR changes coming in from next week, and then the pension changes. And there's always rumours that things are going to change in upcoming budgets. The other thing is that HMRC have recently confirmed their commitment to digitisation of IHT returns. At the moment, if anybody online completes an IHT return, you will know that basically what you do is you fill it in online, but then you print it off and you send it through snail mail to HMRC, which limits the ability for the revenue to risk assess these very closely. Basically, they just have somebody flicking through a paper return. And so the kind of inquiries we get at the moment are very route one. I mean, actually, APR and BPR tend to be looked at disproportionately. So, you know, but if they digitize returns and returns go online effectively, then they will be able to do risk assessments. And I think that we're going to see a lot more inquiries into all areas. But I just want to focus on APR and BPR. Obviously, we have a change coming in next week, hugely controversial change. We've got the legislation now, although, of course, we had an early Christmas present on the 23rd of December, in that the limit that qualifies for 100% APR and BPR is now £2.5 million rather than £1 million. So basically, any assets that you have that qualify for APR and BPR, you only get 100% relief up to the first 2.5 million. Above that, you only get 50%. That limit is transferable. AIM shares are also moving to the category of assets that only get 50% relief. Allowance is transferable, refreshes every 7 years, and it will actually cover transfers on death, failed potentially exempt transfers and chargeable lifetime transfers, and also impacts trusts. APR and BPR, somebody's asked. Yes, sorry, I do appreciate the slide. It's not very clear. Basically, you have £2.5 million at 100%, which covers both your APR and your BPR assets. So if you only have assets that attract APR, then you get 2.5 million for them. If you only have assets that attract BPR, then you get 2.5 million of that. If you have both APR and BPR qualifying assets, then it is a joint limit, and you can decide how you allocate it between the two. So yeah, there is some planning to be done. I have to say that whilst in absolute terms, I'm very pleased with the fact that they upped the limit. I have got clients for which we have done a huge amount of planning based on a £1 million limit, which is frustrating. I think it is also very important, though, to acknowledge that there are other areas where the revenue can attack and will attack BPR and APR. So, for example, you cannot get BPR if a business consists wholly or mainly of dealing in stocks, shares or securities, dealing in land or building, or making or holding investments. And effectively, HMRC do look at investment businesses quite closely. It's considered very extensively in case law. What the revenue we're looking at is the difference between passive ownership and active ownership. We've had a lot of cases looking at serviced property, commercial and residential, furnished holiday let properties, although furnished holiday let has disappeared as a type of property, livery, caravan parks. All of these things are the types of business that HMRC do not believe qualify for business property relief, and have challenged whether or not BPR applies. It's wholly or mainly, so that is a 50-50 split. So if, for example, you had, you know, actually those examples are quite difficult, but let's just say you had someone who had serviced property. Now, we'll say they had a caravan park, and then they also had other activities in there that were very clearly trading. There can be trading activities associated with things like holiday parks, but it tends to, you have to be able to show that you are providing services beyond just allowing somebody to dump their caravan somewhere. So the revenue would typically be looking for things like bars and swimming pools and those kind of things. Caravan sales can be very helpful, or so on, but it is quite a difficult area. But there's lots of case law that you can have a look at. Even if you are a trading company, we also then need to consider whether or not there are accepted assets within the business, which are assets that are not used for the purposes of a business within the company. But if there is a business, such as a rental business associated with that property, then typically they will not be accepted assets. But again, as for BADR purposes, cash is the one area where there can be significant problem with having surplus cash. And that is an area where the revenue do attack it very closely. I had a case maybe 3 years ago where we had a company that was an engineering company, and the business premises were owned by the husband and wife, who were the main shareholders. And the reason that the husband and wife had bought the property in the first place was because the company was seen as too big a risk and they couldn't get financing. And the company had been accumulating cash in itself, saving the cash in order to buy the property off the two individuals. The two individuals, sadly, one of them developed motor neurone disease and then died. And then the wife developed very aggressive cancer and also died. And so the daughter, who took over the running of the business, then had to get probate, then had to deal with the estate, and therefore there was a significant delay in the property being purchased, even though the company had enough cash. And the revenue basically said that the cash was an accepted asset, and therefore tried to restrict the BPR on the company. Well, we did manage to win that argument, thankfully, but that would have been a bit of a nightmare. A holding company can be an investment company. Most holding companies will qualify, but you need to be very careful in terms of structuring holding companies to make sure that you do not have any problems with BPR, with getting BPR. We're getting to the end of this course, and this is not a specialist IHT course, so I'm not going to go through this in any detail, but just to note that from the perspective that it can be quite difficult. Okay, a couple of final questions. Is it possible for shareholders to withdraw cash from a company's dividends after leaving the UK without being liable for tax on those dividends? Dividends from a UK company are what are called accepted assets, or disregarded. So it's disregarded income. In most cases, they will not be subject to UK tax, but it does depend on the circumstances. And of course, that would be income that would come back into charge if indeed somebody was only temporarily non-resident. Basically, that is the point. Okay, that brings us to the end of this session. And hopefully you found it useful. I will be back with you, I think, in the summer. But thank you and goodbye.